Welcome to Trading with Venus podcast, episode 51. I'm your host, Raman Gill. We're back on track with the show after an extended break over the summer. My apologies for being away for such a long period of time. However, going forward, we'll continue this podcast without any breaks. So every week we will have a new show for you. Today's topic is what is the impact of balance sheet reduction by Fed on currency trading? Lately, we have been seeing central banks have been changing their stance on monetary policy. So, a couple of weeks ago, Fed announced that they are going to start reducing the balance sheet. So, let's take a look at what that means to us for our currency trading and how we can use that information to take better trades. Just a quick disclaimer before we get started. This is for educational purposes only. Trading is a risky business, so please be careful with your money. So, question that got sent to me was around balance sheet. We have talked a lot about what the changes that the central banks are making and the impact that is having on the market. So this is the question that I wanted to address. But in order to address this question, there are a few things we need to understand around the whole balance sheet and what's going on in the market. So I thought we'll go over monetary policy and fiscal policy, the different tools that the government has to impact the market. And then we'll talk about interest rate, what impact the interest rate has on the markets and what impact the balance sheet reduction will have on the market, and how do we trade these things. So that's what we'll talk about today. So to begin, first thing we need to look at is what are the different tools that the government has at its disposal in terms of managing the markets or impacting the markets. Really, there are two different tools that the government has at its disposal. The first is fiscal policy, and the second one is monetary policy. So fiscal policy is government's policy in regards to taxes and spending, and we'll take a deeper look at that in just a minute, whereas the monetary policy is implemented more through to the Fed, the Federal Reserve Bank, and that is to do with interest rates, the bank reserves, and securities. So we'll take a look at both of these policies in a little bit more in depth, and then we'll take a look at what impact these will have on our trading. So let's start off with fiscal policy. Fiscal policy really is how a government can impact the economy of a country through its spending programs or taxation policies. So lately there has been a lot of news or a lot of comments in the news around the tax reforms that are going on. So the proposal that President Trump has put forward in regards to the tax reforms. So expecting the tax reforms, market was actually doing quite well. And the reason the tax reforms are important is because when you cut taxes on the businesses and individuals, both of these entities will have more money to spend. As a result of that, they will invest back. The businesses will invest back into the business. They will hire more people, and basically overall they will be more productive. So when revenues grow, profits will grow as well, and as a result, the taxes that government is collecting overall will grow as well. So that's the thinking behind the tax reforms. Really, it's meant to stimulate the economy and give the money back into the businesses and individuals' pockets. So that's the whole purpose of tax reforms and cutting taxes. The other thing is spending programs. Spending programs are things that government can spend money on. So after the financial crash, government has been doing a lot of spending on infrastructure projects. So for example, building bridges, fixing roads, and taking on public works projects. And when they do that, this is really to help, again, stimulate the economy, create more jobs, get money into people's pockets so that people will then go spend that money, and that will then create this flow of money throughout the economy. So these decisions are made by the Congress, and they get voted in the Congress, and administration implements these policies. So the Federal Reserve does not have any role to play in the fiscal policy. So this is all done through the government. In terms of the fiscal policy, what we have seen over the last few years since the financial crash in 2008, 2009 has been an expansionary fiscal policy. And expansionary fiscal policies where the government is spending money, cutting taxes, basically putting money into the economy. And the purpose of that is to help speed up the economy, stimulate the economy, so there is more spending, there's more jobs, there's more money in people's hands. Now that we have done that, instead of contracting the fiscal policy because the economy is doing quite well, what President Trump is suggesting is that the economy needs more help. And as a result of that, we need to do tax reforms to give more money back to the businesses and individuals so that they can go and invest that money, and they can create this flow of money again. So contractionary fiscal policy generally slows down the economy because money is pulled out of the economy, but that's not what's going on at the moment. We're talking about tax reforms and getting money back to the people. So we're still in an expansionary fiscal policy environment in the US. So that's where we are. At some point, we'll go into the contractionary fiscal policy, but for now, US is in the expansionary fiscal policy. So now let's take a look at monetary policy. What is monetary policy? So monetary policy is basically a term that we use for actions of the central bank to achieve economic growth. So central banks, we had talked about the government, what the government can do. Now we're talking about what the central bank can do. So central banks, the main objectives of central banks are that they want the economy to be stable, they want full employment, they want stable prices, and they want the currency to be strong. Those are some of the objectives that the central banks have. And big thing, both the government and the Fed want is that economy is growing, things are stable, prices are not out of control. Basically, everything is growing at a steady pace and people are employed, so they have jobs and they can spend the money in the economy to keep everything going. So both the government and the central banks have similar objectives, and they just influence them slightly differently. So in terms of monetary policy is completely separate from fiscal policy. It is implemented through the central bank. So right now, over the last few weeks, we've been hearing a lot from Bank of England, Bank of Japan, European Central Bank, Reserve Bank of Australia, Reserve Bank of New Zealand. So all of these have been in the news. We see Fed's Chair Yellen speaking all the time. So right now, we are going through a shift in central bank stance. So for a long time, we have been in expansionary monetary policy era. Expansionary monetary policy is where the central banks are pumping money into the economy in order to stimulate the economy and help the economy grow. Whereas contractionary monetary policy is where things are going well and now they're concerned about prices rising too much, so inflation getting out of control, and they don't want things to get out of control. So because the concern is that we don't want to create bubbles in the economy which then burst and have a very, very bad impact on the overall economy. So they want to prevent bubbles, but they do want steady growth. So once they have stimulated the economy and economy is doing quite well, then the central banks have to pull back a bit. It's like taking the wheels, the helping wheels off of the bicycle so that the economy kind of goes on its own and those little wheels are not required anymore. There are three ways that the monetary policy is implemented. First one is through discount or interest rates. And second one is the reserve requirements that the Federal Reserve Bank will implement on the other charter banks. And then third one is open market operations. So we'll take a look at each of these things individually. So first one is interest rates. So there's been a lot of talk about interest rates lately. We have seen some banks central banks have raised interest rates. So we have, for now, Fed has been raising interest rates. Bank of Canada has raised interest rate. Bank of England has started talking about a potential of raising interest rates. So those are the three main banks that have kind of talked about interest rates. ECB hasn't done that yet. Bank of Japan hasn't done that. Reserve Bank of Australia and New Zealand, they are holding pat. So that's where the central banks sit at this present moment in time. So what is a discount rate? Discount rate is basically the interest rate that the central banks will charge to lend money to commercial banks. So at the end of every day, all the banks need to settle their books. And what happens is when they're settling their books, they will be out because they haven't collected all the money yet. Maybe it's in the books, but it hasn't been collected. So they may need some extra money in order to balance their books at the end of the day. So what the commercial banks will do is they will borrow money on a short-term basis from the central bank, and the rate that they borrow money at is called the discount rate. Right? So lower the discount rate, lower interest they have to then charge to their customers, because the banks will use this money for various purposes, and part of it is lending to their customers, right? So the higher the discount rate, the Fed rate, the higher interest the commercial banks have to charge their clients. So discount rate that the Fed charges the commercial bank has a big impact on the interest rates that we see in the market. So how does the interest rate then impact the economy? When the interest rates have been dropping, so this is what we have seen for the last 8 years, where the interest rates have continuously dropped. So when the interest rates are dropping, the banks can lend the money to their customers at lower interest rates. So when the banks are providing lower interest rates, more people are interested in borrowing the money. And when people borrow the money, they will then go invest it, either buy things with it, so they put money back into the economy, or they will use the money to invest in their business. They will build new plants. They will hire more people, provide more jobs, that type of thing. So the businesses borrowing money at low interest rate is very helpful for the economy, because it just creates that sub-business cycle of growth. And when individuals borrow money, they will go buy cars, they will go buy houses, they will buy furniture, the items that they won't buy when everybody's hunkering down. So they will go spend money in the economy, and as a result, more people will get jobs because people are spending money, and again, it stimulates the economy. So low interest rates are good for the economy. They create growth in the economy. Whereas when the interest rates are rising, which is what we have started seeing now, Fed has done 2 interest rate hikes this year. They are still on track for a 3rd interest rate hike. And we have seen Bank of Canada already did 2 interest rate hikes this year. Bank of England is talking about potential interest rate hikes. So now we are seeing that shift in the central bank stance. So we have gone from years of low interest rate, like unheard of low interest rates, to where banks are starting to consider interest rate hikes or starting to do small interest rate hikes. So when the interest rates go up, what happens is the banks will then have to charge more money from their clients to give them loans, because they have to pay more money to the Fed to borrow those funds. So as a result of that, less people are interested in borrowing money, because think of it. If you're a business and let's say you make $10 in profit and you're paying a large chunk of that in form of interest, sometimes then the business may not be interested in making that money because they're keeping so little of it. So if the interest payment is so high, you don't want to really take on the loans. The businesses don't want to take on the loan. They will push the projects back and not put that money back into the business. So as a result of that, we'll see some contraction in the economy. More people will be unemployed and that type of stuff, because not as much money is going back into the economy. So high interest rate from economic perspective are bad for the economy. However, the reason the central banks have to raise interest rate is because if they keep putting money into the economy, it can have negative impact. Because so right now, in terms of the US economy, the employment numbers are really good. The GDP is doing well, and we see the retail sales coming in positive. So overall, in the last 7-8 years, market has grown, economy has gotten better, and now we also see that the stock market is at all-time highs, right? So overall, things are looking good in the economy, and the inflation is slowly going up. But the central bank doesn't want is for things to go completely in the opposite direction, like we saw in 2007 and 8, where everything was at all-time highs and we had a bubble, which then burst and created such a negative impact on the economy. So central banks don't want to see that happen with the country. So before things get to that point, they start pulling back slowly. And this is what we are starting to see right now. Second way the central banks can impact how much money is available in the economy is through reserve requirements for the commercial banks. So every single bank has to have a certain amount of money that they hold in cash. So everybody who's depositing money with them, part of that money has to be kept in form of cash with the bank. So the reason for this is, so when somebody wants to withdraw some money, the banks have that cash available to give it back to the people. So it is required so that the banks always have certain amount of cash on hand, so that if things change for whatever reason, they don't kind of go in the hole. That's the reason the central banks put this requirement on the commercial banks. So the way the reserve requirements impact the economy is that the higher the reserve requirements, so the more money the bank has to hold in its reserve, the less they can lend. And if they're not lending as much money, that will have a contractionary impact on the economy, because the more loans the banks make, the more people are spending, and as a result, it just creates that positive flow in the economy. But if the banks are not lending money, then, or they're lending less money, it will have that negative impact on the economy. So right now, reserve requirements are not changing, so that's not an issue we need to deal with at this point. The third issue that has come into the forefront just recently, and two different central banks are talking about this. So Fed just announced that they're going to reduce their balance sheet, and ECB has talked about reducing their asset purchase program. So this is what the asset purchase program is. They're called open market operations. So this is most frequently used tools by the central banks. So what this means is that the central bank will go and buy securities in the open market. So they're buying basically bonds, mortgage-backed securities, these type of things from either the banks, or they're buying them from individuals. Excuse me. And the purpose of doing this, making purchases, and they make huge purchases in millions and billions of dollars. And the reason for doing this is because they're putting money into the banking system, so the banks have more money to lend to people. So again, it's just the whole point of this is to just give money to the banks so they can then go and lend the money out, and it keeps the interest rates low, and it just keeps money flowing in the economy. So when the banks are buying these securities, it puts money into the bank's hands. So when they are selling this security, it has the opposite impact. It will contract the economy. So this is how it works. So the Federal Reserve Bank will buy bonds and mortgage-backed securities from commercial banks, and when they buy that, they give money to the banks, right? So when you purchase something, you give the money. So once the banks have money, they have more money to lend to people, and as a result of that, businesses can get loans at cheaper rate, and they can then reinvest. And same thing with individuals, they can borrow money at cheaper rate, and they can then go put that money back into the economy. So the whole purpose of buying securities by a central bank is to just pump money into the economy to stimulate the economy. And this is what we have been seeing since the financial crash. Central banks have been pumping money into the economy. When the central banks start or stop doing this, or they reduce doing this. So in that case, when they do the opposite, when they're rebalancing their balance sheet, what they do is they sell these bonds back to the banks or individuals, and then they get money in return. So when the banks have to pay money to the central banks to buy the bonds and stuff, the banks have less money to lend to individuals because they're buying bonds. So when that happens, they have less money to lend to individuals and businesses. As a result, economy will have a negative impact. But the benefit of doing this is that it also helps control inflation, so the prices don't get out of hand. We have seen in the past where certain markets, like real estate market, where the prices have completely gotten out of hand, and then all of a sudden people are upside down on their mortgage. They owe more to the bank than the property's worth because we have gone through a crash. And this has happened in the stock market, it has happened in the bond market, it has happened in real estate market. So we see these bubbles from time to time. So central bank doesn't want to see that. So as a result of that, they need to control the inflation, which is the price of goods going up. So right now we are going through the central bank stance that is shifting. So far, pretty much every central bank in the world has followed an expansionary policy. And we're talking about the developed countries because those are the currencies we mainly trade in. So as a result of that, we have seen a lot of economic growth in pretty much all the economies, all the growing economies in the world. We have job numbers that are really positive. So even if you look at UK or Canada, or we look at the US or Australia, New Zealand, all of these places, they have had positive growth as a result of central bank and the government's pumping money into the economy. But now we are at that point where the employment is at a really high rate. We have jobs in the market, earnings are going up, and we see that the economy overall is doing well. So this is the time before it goes too far to the other side where things are overinflated. It's time for central banks to change their policy and start to kind of turn back that engine the other way and pull back some of the money that they're pumping into the economy. So what have central banks been doing? So there are two ways they can tighten the monetary, well, three ways they can tighten the monetary policy, but we'll talk about the two, which is the interest rates and balance sheet reduction. This is also called, the asset purchase program, however you want to refer to it. It's the same thing, basically, central banks buying securities out in the market. So we have already been seeing the interest rates. The way the interest rates impact the currency markets, because that's what we are trading, so we'll kind of bring it back into what we are doing with this. So we trade in the currency market. So the impact the interest rates will have on the currency market is that when a central bank raises interest rates, the currency will go up as well. So we have seen that with Bank of Canada. Bank of Canada raised interest rates, and as a result of that, Canadian dollar has strengthened a lot. And then we have seen Fed has raised interest rates, and we did see strength in the US dollar as a result of that. But then there are other things playing a role in terms of the US. There's politics and other things going on, a lot of comments and stuff coming out. So that has created a little bit of market instability in terms of the strength in the US dollar. We haven't seen US dollar as strong as we would normally see it because of other things that are impacting the US dollar. But generally, when the central banks talk about raising interest rate, the currency will strengthen as a result. So we saw that with Bank of Canada. We saw that with Bank of England. Even though they haven't raised interest rate, they have just talked about potentially raising rates. We saw the British pound go up as a result of that. So there's a direct relationship between interest rates going up and currency strength. So there's a positive correlation with that. And the reason that happens is because when a bank raises interest rates, it creates a high demand for that currency from investors. So let's say Bank of Canada is raising interest rates. People would want to put their money in Canada, even if they just put the money, let's say they borrow the money in something that's really low, for example, Japanese yen. They have negative interest rates, so you can borrow the money from there and put it in a Canadian bank, just getting interest. You actually get a positive return on your money by just leaving the money in a country that has a higher interest rate. Same thing with Australia, New Zealand, they have high interest rates. So you could just borrow money in a country or in a currency that has low interest rate and then put it into a bank account that has high interest rates. So that's called the carry trade. And that's what investors will do. They will just borrow money from one place and put it in another. They don't have to do anything. You're just making money on the interest rate differential. So that's why, so it increases the demand for that currency. So more people buy that currency, the higher the currency will go. And as a result of that, we see that currency gets stronger. So this is how the interest rates work. So now let's take a look at balance sheet. So reducing the balance sheet is the second thing that the central banks can do. So with the Federal Reserve Bank, they have, all central banks have a balance sheet. So balance sheet is basically, it shows the assets and liabilities of the central bank. So just like any company, any corporation out there, they have a balance sheet that lists their assets and liabilities. So does the Federal Reserve Bank. It shows what the bank owns and what they owe to someone. That's called the balance sheet for the bank. So over the last few years, as we have talked, the Fed's balance sheet has grown. So right now, the Fed's balance sheet sits at about $4.52 trillion. So that's how much stuff they are holding, how much securities they're holding on their balance sheet. So this consists of treasuries, mortgage-backed securities, and different types of bonds that the Fed has bought in the open market so that they can put money into the market. So that's what they have done. Because they are buying these things, it creates the demand for these things. And as a result of that, the prices of these assets will continue to go up, and it just creates that flow of money in the market. So since the financial crash, we've seen about $3.7 trillion worth of these purchases that have been made by the Fed. So essentially, it just creates that effect in the market that's inflationary, keeps the things going up because the Fed is creating that demand. So this is called quantitative easing, or we have another term you hear about. This is called printing money, right? So basically, they're pumping money into the economy, and the whole point of doing that is so that they encourage risk taking in the economy. But as we have seen, the prices of assets like equities have gone up like crazy. The stock market is doing really well overall. The Wall Street is doing really well. So this has created that flow in the market, which is good. People are willing to take risks. They're willing to invest in different assets, which is a positive thing. So since they have done that, now it's the time where Fed is starting to pull back. So interest rates is one tool that the Fed has. They have been raising interest rates, but what goes hand in hand with the interest rates is also this balance sheet or bond buying program. So they need to reduce that as well, because they can't just keep on raising interest rates and keep buying these assets in the program and injecting money into the economy. So they kind of need to do both of them side by side. So Fed has now announced that they're going to reduce their balance sheet, and ECB actually, instead of raising interest rate, they are saying we are going to cut back on the asset purchase program so that they are not putting as much money into the market, and they're not buying as much securities in the open market. So those are the two banks that have talked about this. So let's see how does this work. So current policy that the Fed has is that when the bonds, so each bond, it's a debt instrument, so each bond will have a maturity date, right? So when the bonds reach their maturity date, currently what the central bank does is, or what the Fed does, is that they will go and take that money and then put it into something else, right? So they're basically buying more bonds. When the previous bonds reach the maturity, they kind of go and buy more bonds. So this just keeps the demand for the bonds in the market, and it helps the rates be low. But now it's time for Fed to unload that balance sheet or rebalance the balance sheet. There are two different ways the Fed can do that. One is by simply allowing the bonds to run off naturally. Excuse me. What that means is that when the bonds reach their maturity dates, instead of taking that money that they have in their hand and buying another bond with it, they just do nothing with it, right? So once the loan runs off, it's done. So that is one way to reduce the balance sheet. The other way is to actively go and sell those bonds in the open market, right? So the first method of just letting the bonds run off naturally at maturity, that's a more passive way of reducing the balance sheet. And that's the method that the Fed prefers. But there has been a lot of kind of back and forth between the different Fed officials as to how the Fed should do this. So they haven't really come up with a solid plan as of yet. But those are the two different ways that when this happens, that's how they're going to do this. Either, and they'll probably use combination of the two, because they can't just go actively start selling bonds in the market, because that will create a lot of supply in the market, and the prices will decrease, which is not what they want. So they want to do it slowly and at a steady pace. So a combination of these two is where they will end up. They will let some of the bonds, as they mature, they will kind of roll off of the balance sheet, and as the market kind of holds steady, they may start selling some of these bonds as well. So that's what's going on in terms of the balance sheet, and so this is what the balance sheet means, and this is how the Fed is going to reduce the balance sheet. Now the question is, what impact does that have on us as traders? So the impact of Fed reducing its balance sheet on the market is, for stocks and bonds, it will be a negative impact. It will make the prices of those assets go down. But currently, we have seen two different kind of forces in the markets: interest rates going up and Fed reducing the asset purchase program or reducing the balance sheet is generally a negative impact on the equities. But right now, the equities are shrugging this off. We are not seeing the negative impact on the markets. Basically, they're just ignoring the Fed or what the Fed is doing, because they are focusing more on the tax reforms and other things. So there is this mood sentiment in the market where people are expecting the market to just keep on going up in terms of the equities. So we may see over the coming months certain adjustment in that area as the Fed starts to do more of these selling of these bonds or reducing the balance sheet. And in terms of currency, this has a positive result on the currency. It increases the currency strength, because basically the central bank is not pumping money into the economy, which will cause the interest rates to go up, and which will cause the currency to go up. So as a result of the balance sheet reduction, we should see a positive strength in the currency, or positive impact on the currency strength. So that's what I would suggest just keeping in mind. This doesn't happen overnight. This is more a fundamental it's the fundamentals that we are dealing with here. So it's not going to happen overnight. We do need to keep other things in mind that's going on, and comments that come out, tax reforms, things like that will also impact the market. But in the long run, this is what we need to understand in terms of the monetary policy, fiscal policy, and reducing the balance sheet. So I hope this makes you understand kind of the overall picture a little bit more. So when, I think it was a couple of weeks ago, when Fed said they're going to run off the balance sheet or reduce the balance sheet, we saw the US dollar jump up. And this was why. This is kind of the whole reasoning behind that happening. That's it for today. Hope you enjoyed this episode. If you have questions about trading that you would like answered, please send them to me and I'll attempt to answer them on the show. The email address to send your questions to is questions@tradingwithvenus.com. For show notes for this episode, please visit tradingwithvenus.com/podcasts and look for episode 51. Thank you so much for choosing to spend this time with me. I really appreciate it. Have a wonderful trading week, and I will see you next time.